Sup, freaks? This was brought to you by River. River's a Bitcoin company built by Bitcoiners for Bitcoiners the right way. There's no trusted third parties. They build all their infrastructure. They have free DCA because they know it's the best way to buy Bitcoin. So if you want to buy Bitcoin, you want to mine Bitcoin, you want to send Bitcoin over the Lightning Network, you want to plug into their Lightning Network API. If you're a developer, they're building all these tools for you. They also encourage self-custody. Again, they're Bitcoiners. They want to provide an on-ramp for you and then teach you and encourage you to take control of your own Bitcoin. And they're doing this. It's a beautiful company. If you do hold Bitcoin on the exchange, you can know for sure, since they don't rely on any third parties, they don't lend your Bitcoin out, they don't speculate with your Bitcoin. Your Bitcoin is held in a multi-sig wallet with 100% reserves. Okay? So go to river.com/TFTC, take advantage of the no-fee DCA. You set up your dollar cost average. You don't pay any fees on those buys. If you're a developer, they have their Lightning Network Services API that you can build on. You can send over Lightning. You can mine via River as well. You may have your exchange. You may be comfortable with it, but have you tried River yet? It's a question you have to ask yourself. If the answer is no, go try it. That's where all the Bitcoiners are hanging out. That's where I get my Bitcoin as well. River.com/TFTC. Thank you guys for listening. If you're listening on YouTube, please subscribe, set the notifications up as well. We're going to be putting out a lot of content this year. If you want to subscribe to the podcast feed as well, if you're not around your computer or not listening on YouTube, but you want to catch the podcast on the podcasting feeds, subscribe on your favorite podcasting app. And if you want to learn more about Bitcoin, I write a newsletter almost daily during the week. Go to tftc.io, subscribe on the website, and you'll get pure signal on Bitcoin, macroeconomics, geopolitics, whatever tickles my fancy that day. Thank you guys for joining us. Thank you for supporting the show. If you can subscribe, rate, review, goes a long way. We're trying to blow this up in 2023. Enjoy the rip.
Ready to roll, and we're rolling. Matt Dines. Got through some technical difficulties there. Are we okay?
We are. I actually learned something about the Microsoft Office suite today that I didn't know. So you're always an Excel junkie doing anything in finance. But yeah, it's always interesting when you learn a new bell and whistle inside of MS Office.
I haven't had to deal with MS Office in almost a decade. I don't miss it.
No 1031 VC deal, number crunching going on in Excel.
I do it in the Excel on the MacBook, but that's the extent. I don't have to do PowerPoints anymore.
Got it.
Yeah. But regardless, we're here to talk about something very important on Microsoft Office. The state of the private retirement fund landscape in the U.S. You are somebody who has thought deeply about this. I'm joined by Matt Dines from Build, a Bitcoiner who's looking to solve a very hard problem, which is how do we ensure that people who have been saving for retirement for decades now actually have money when they go to retire. So I don't know where we should start. Maybe we should start with the gravity of the problem, maybe describe the dynamics of what allowed the problem to get to as big as it is, and mention that a lot of people are focused on the lack of funding for things like Social Security, public pensions like CalPERS, but what you're focused on is a completely different area of the retirement landscape that I think you would argue is very underappreciated and is sending signals that something is wrong that many people aren't paying attention to.
Yeah. If you just start from the basics of the landscape, you don't have to go back to when the wheel was made. But, as this retirement system that people accrue and save their purchasing power, from their working years into their latter years, something that, the Bitcoin audience and the freaks are well aware of. Big part of this kind of movement into Bitcoin is finding a money, right, that protects and can act as a store of value, preserve its purchasing power. But over the last, and you could really start in the post-World War II decade or post-World War II era, We don't have to go that far back in history, but this landscape that's built up in a world, prior to where Bitcoin existed. You've seen the kind of the American household, the middle class, build up around. We'll go into the data here. Either the one aspect is Social Security benefits that you mentioned, public or private pensions. But those, Social Security is still there, obviously, but the pension plan landscape has really kind of fallen by a wayside over the last, let's say, 4 decades since the 1980s. And what you've seen kind of take its place is an increasing reliance on financial assets, so stocks and bonds. And those are really just tucked into, where most households hold them is going to be retirement accounts. And then second on that is the primary residence. So Logan has brought up this slide. The Fed actually publishes this data series. It's just a wide kind of panel survey every 3 years. They've been doing it since 1989. It's called the Survey of Consumer Finances. And it shows where American households they really own their assets. They provide a lot of data here. It's one of the richest sources kind of available on, how the American is saving. It's just fundamentally a huge part of what Bitcoin is trying to accomplish on its mission of delivering something that is resilient and lasts. But you see on this chart here, this survey of consumer finances, and Bitcoin is never on here. It's never really been a line item on American household balance sheets in this report. We'll see if there's a breakout. 2022 will be the next year published in this series, but that won't come out until later this year. So all this data reflects kind of the progression of this stock and bond bull market from the early 1980s till give or take 2022. We'll see as the kind of financial asset track record puts on more years, and we see whether that unwind in 2022 is part of something lasting. But anyway, what you see on this report is every kind of light item that you can think of on an American saver's balance sheet. It's kind of categorized in this series. And you see data on both how many households own these assets and what you can measure the account balance 2 ways, either the median or the average. Averages, if you take them for a group, they're going to skew higher because the highest account balances are going to just pull the average up. So what I used here on this chart is the median. It really gives you a better reflection of where the kind of typical owner of an asset, an American owning specific asset on their balance sheet is sitting. So Logan's pulled up this first chart here, and the way I designed this is you've got 2 arrows here. You got the start of the arrow is where each asset class started. X-axis is the percent of American households holding a given asset, and then the Y-axis is the median account balance. So the tail of an arrow is where this was in 1989 when the Fed first started producing this survey, and the end of the arrow, the tip of the spear, is where the point landed at the end of 2019, the last reading. We'll get an update at the end of the year, but this right now kind of the best indicator we have of kind of this big picture tide shift of what's going on, kind of the state of the American household's balance sheet. So we just go right to left here. I'll start with the big one, the middle blob, that gray blob. There's only 2 items or 2 assets that really the majority of Americans hold on their balance sheet that have any meaningful both ownership or like value on them. And the first line is your primary residence. And this one makes sense with kind of all of our lived experience. You've got housing prices just going up almost continuously over the last 4 decades, except for 2 big hiccups. One, really. You can say right now there's a big pullback. That's not going to be on this chart. The only one that would be on this chart, or like in this time sample from 1989 to 2019, is the 2008 crisis. But other than that, the primary residence is your number 1 store of value for your majority of middle-class Americans. And then your second is going to be retirement accounts. So you see the arrow. It starts at like 40% ownership. It ramps up to about 50% over 30 years. And then you see the median balance increase from about 25K up to, the mid 60K range. So roughly a doubling. Housing prices increase more, but those two arrows are really, the store of values that Bitcoin is competing with as the space looks to grow. But those other blobs, as you cluster those other line items, they really tell you a good story of what's going on with how the typical American is living, kind of as a broader case study. If you start on the bottom right, the little blue dash line, those two assets that fit in that bucket are, I call them broadly owned, but they have not gained in value over this 30 years. So number one is vehicles. So, mid 80% of Americans own their own vehicle. Benchmark value, maybe 10 to 20K. Now that's changed in the last 3 years as we got this massive inflationary impulse. And you saw things like used car prices shooting up. So that's kind of an interesting kind of dynamic of what's going on in this process. But by and large, most Americans on the household balance sheet own some vehicles. They have not gained in value. Most of them are, Americans are owning their vehicles longer than ever. Saw a print in the last couple of weeks. I think the median age of an auto in the U.S. fleet is now 14 years. Kind of same trend you see in the housing stock as well. The housing stock, going back to the primary residence, half of the housing stock is structures built pre-1980. So you're seeing price go up on existing structures, and this is something that I think the Bitcoiners are well familiar with from the trend of kind of a credit bubble monetizing itself through. You just got to keep rolling over loans, increase debt, and you end up with just more credit on the same assets. And then the second account in that broadly owned, no gain in value group is transaction accounts, so checking accounts. So you've seen ownership ramp up there from like low 80s penetration or mid 80s penetration up to near 100%. Almost everybody will have some sort of, I call it a transaction account in this report, but it's basically just checking accounts. Just where do you store your dollars for readily available access. So then you get into the left two clusters, and this is kind of a good benchmark for what's going on in terms of both markets that are growing as well as kind of the shift of who's gained a lot in value as this monetary system and policies have gone the way they have. So that first group, the red bucket, I call these groups the declining ownership and no gain in value. And once you see what's going on here, a lot of these are monetary related. So you see number one here is certificates of deposits. No one's made much money. Median account balance has not grown in CDs, and they're falling out of use. Part of this was in the 2010s. The monetary system went the way it had to, or it forced you to deal with its can kicking down the road. So zero interest rates. So pretty obviously people flocked out of CDs and other just short-term monetary assets. And you kind of saw a return to that, or you're seeing a return to that right now as we move interest rates up. There's a minor, I guess, transition. We saw this same effect in 2018 when rate hikes came up. People flow into money market funds, certificates of deposits, all that type of stuff. But it's really been temporary. The trend has been down, and there hasn't actually been that much money made for median account balances in that line item. Second, cash value life insurance. So this one's kind of surprising once you see the data here. That once you see the movement of ownership from mid 30% down to 20% of American households owning life insurance policies. It really speaks to a market or a product space in decline. So big feature here of what this data is describing, inside of that whole kind of school of fish in that red group is a lot of monetary products kind of transitioning out as hopefully other markets are going to grow and take their place. But the life insurance market, that was something that kind of surprised me the first time I was looking at this data. It's kind of bundled into the entire monetary landscape. People are using that product less and less. and it's kind of failing as that store of value or use of value use for American households that it once was. Number 3, savings bonds. I don't know if you guys ever had this experience, but my grandma, when I was little, used to give me savings bonds for Christmas. I don't know if you ever got those.
Well, that was funny. My grandma used to give me CDs. When you mentioned that, she's like, "Yeah, I set you up with a CD. It's going to be gaining interest." This was like in the 90s when interest rates were above 0.
Yep. And it really feels like, as you see this, it's kind of a different era, right? I mean, the way you might give you talk about on TFTC, wedding gifts, et cetera, you're giving, open dimes with sats on them. It's just a different era. Technology is dying, or a monetary instrument is phasing out. We're moving to the new. But you see that number 3, savings bonds. Haven't gotten one of those in quite a while, and hopefully you cash those in quite a while ago too. Number 4 is a little bit surprising in this group: directly held stocks. So this is like when the American household actually has a brokerage account and they're buying single name tickers like NVIDIA right now, right? How many households are flocking into that? This was 2019. It'll be interesting to see in the latest round how many households plowed into brokerage accounts, especially in the pandemic. Like we saw, massive waves of people moving onto like Robinhood or other
Cash App,
but brokerage, right? Exactly. So it'll be interesting to see that trend. But over this time frame, massive bull market and equities, you saw ownership decline and the median account balances decline. So like the average household was not making money buying single name stocks. Number 5, other financial assets. This one is stuff like oil and gas rights, lawsuit, or like just pending settlements. It's just a catch-all for other like paper claims or loans made to other households, for example. Really just a catch-all, but the other categories even dying there on financial assets. And then number 6 is other non-financial assets. Like this could be commodities, gold stored in a vault, or a safe, something like that. That's also in decline as well. So you see that red cluster, kind of the way I take that bucket is that, like this. These are the industries of like the monetary products that are no longer working. The paper savings bond, that I got on Christmas, or your grandmother giving you a certificate of deposit. I don't think we're going to be getting too many more of those in the future, but time will tell. And then the left one, the limited ownership gain value. I think this is where, you speak of the Kids Hill effect, a small number of people making a lot of money. You saw, fewer than 10% of the population owning these assets, but median balances are
skyrocketing,
just increasing. Yeah. So the number 1 here, that line is other managed assets. This is really annuities. And then things like managed accounts. So if you have a financial advisor managing a brokerage account in your name, that'll be mapped here. Specific types of pooled fund, hedge fund ownership, stuff like that. So those have obviously done really well over the last 3 to 4 decades in a financial asset kind of like boom. And then number 2, directly held bonds. So if you actually own the QSIPs, the people who are buying you say treasury bonds, but it's, corporate bonds, securitized debt, those, like the people who own those have really large balances in those accounts. Number 3 is pooled investment funds. This is what Build actually does, which is just you manage one to many just vehicles where you have an investment manager, someone who is credentialed, regulated, SEC oversight, that type of stuff. But these are investors, American household balance sheet holdings in those assets. So those have gone up as well. And then 4 is other residential real estate. So just like your primary residential real estate went up, like if you held your second home or third home, investment properties, et cetera, those are also going up in value. That's like a tiny minority of the population. But what you see here is, it kind of tells a picture of what's going on in this massive 4-decade asset bubble ever since we came out of 1970s great inflation, you get or you get an environment where interest rates are just in secular, but cyclical decline. Bull market in bonds, bull market in equities. This is the way it works out. But the crux of the story really is, as we enter this kind of next phase of whatever we're turning into, and Bitcoin adoption is going to have to compete in, kind of the legacy holdings, the store value for the American household. Everything is riding on your primary residence, your household, your home price is holding up. And number two is your retirement accounts. So your retirement accounts have been favored by policy. We can do like a brief history lesson here. But really this came out of a movement in like after World War II, between the 50s and the 70s. You saw a lot of American just industrial companies, a lot of businesses starting to struggle to uphold their pension benefits. You saw some failures in the 50s, kind of as America exited World War II. We were the kind of the factory of the world, but you gradually saw under this, you could say, the Bretton Woods monetary system, the dollar system, U.S. companies became less competitive, and that liability on the balance sheet to maintain pension benefits for your aging workforce, that became a problem. And you saw a lot of pension failures. So first step was this law, I think it was 1974, it's called ERISA. It basically put the first layer of kind of like regulation over the pension industry. But over the next, let's say 8 years, 10 years, you saw a shift away from companies wanting to put that liability on their balance sheet, right? When you had a pension, if you're a retiree, you just get a check in the mail every month. It doesn't show up on your balance sheet. It's not like a recognized or valued asset. But as the company, as American corporations kind of shifted away from that, the model shifted over into what's called defined contribution, which basically just means instead of the companies kind of signing up for a benefit amount as the worker exits into retirement, it becomes just they'll give you a specific contribution with each paycheck, and then that sits in an account. So you as the worker actually hold some level of ownership over the asset. Now, the amount you get for that asset once you turn 65, that's on the worker now. That's on you. That's your responsibility to invest it and build up a nest egg that you can kind of pay for yourself once you're past your working years. But it does, if you think about this from the Bitcoin perspective and in the sense of ownership, I think it is kind of a big picture trend, as you measure things over decades and centuries, you kind of see the ebb and flow towards individual ownership, individual responsibility, even in that one move right there from defined benefit to defined contribution. Now, the assets piled into that defined contribution plan have all been, it's basically stocks and bonds. When you go look at a 401k, right, your investment menu, right, you'll generally get 10 to 15 funds you can invest in if it's a corporate retirement plan. And you'll see some equity funds, some bond funds, and then usually it's just like investment mix, right? We'll talk about this later, but the movement into target date funds, which is just basically a fancy financial industry project to just say own your age in bonds. But you do see that mix at least in terms of if you're looking for a silver lining, and the data we'll talk about. I think one of the positive things is you're giving more control to the individual, more responsibility to the individual as they own those assets. But this is just a highlight here. We were looking at that chart. It's very clear. The system right now is built upon a kind of like a foundation of house prices. And we talked about that. The housing stock is aging. We're not really building new at the rate we need in the American housing stock. And then after that, it's just retirement plans, retirement accounts, and then stocks and bonds kind of piled into that. So that's kind of the landscape we're running or we're working with as we enter this kind of new phase of what comes after the COVID monetary impulse.
Yeah, and it paints a pretty precarious picture. Excuse my alliteration, because it does a number of things. One, it highlights like the emergence of the BlackRocks and the Vanguards of the world, essentially providing people the menu of the different stock and bond blends that they can opt into to pour their retirement funds into. So really, that chart that you just shared. So if you freaks are listening, we do have charts that are accompanied with this episode. If you want to go watch on Spotify or YouTube or Rumble, you can see them there. But just to try to articulate what we just saw for anybody who does not want to go watch this on a screen, is just listening. You essentially have a large portion of Americans' wealth being transitioned into real estate and retirement accounts specifically. And why this gets really precarious is on the real estate side, as Matt mentioned, a lot of these houses are very old, and houses are physical things that do decompose and have upkeep cost, and it's simply wear and tear throughout time. Then the other are these retirement accounts that people are just funneling into. You get your menu. Even though you do get optionality within that menu, you're essentially just dumping your money into stocks and bonds that are heavily dependent on monetary policy, essentially injecting liquidity into the system. And then on top of that, we have the demographics that come into play, which is we have the baby boomers retiring right now. And so when you couple all of that with what's going on in the economy, obviously the financial system seems to be a bit fragile right now, as we've seen with the bank situation over the last 6 months, as we've seen with the debt ceiling impasse that we recently had, but got over. We raised the debt limit again. And is it what, after talking with Matt many times over the last 6 months, this particular section of American wealth held in retirement accounts is a very scary situation, because if you have all this tumult in financial markets, driven mainly by monetary policy and the value of the bonds, and stocks are still holding up pretty well, but it wouldn't be too crazy to think that they're not going to perform as well moving forward if we do head into a recession. You have the value of those retirement accounts falling just from pure performance, and then on top of that, we have the demographics come into play, where a large section of the American economy is going to be for sellers because they need cash to live their lives in retirement.
It's a difficult setup. That's for sure. When you're talking about the impending recession, like that's very maybe short term. How do you get through the next 6-12 months? This is a problem that's going to need to be worked through and resolved. And we talk about Bitcoiners talk about this transition, towards Bitcoin adoption, a Bitcoin standard. That has to be built. But what we're talking about here is a kind of a system built upon pillars that are, on a shaky foundation as is. So, I kind of compare it to that Indiana Jones. What was the movie? Was it Raiders of the Lost Ark, where he flips? He puts his hand back on the gold statue. Like it's got like pulling an easy handoff. That's going to be hard to do. But to paint a positive picture here, I think just to point out, we'll talk about what Build is doing with some really important partners and people we hold in a really high regard, and what they've built on Bitcoin in the last, let's say, 5 to 10 years. This transition's not going to be easy, but keep building. But on that topic, I think that the next chart based on this data series, if you lay out the data in a certain way, you see a very clear trend that this big picture system, zooming out on a 3 to 4 decade time horizon, is already struggling here. So you see retirement account participation. We mentioned how it is a pillar asset for American households. It's already, I would say it's in structural decline at this point. Like it is already buckling. I would say the signs are already there. So you saw this data series every 3 years they print the survey of consumer finances report, they break out all this data so you can see not just for the like collective American, household audience. You see it by age group. So they bucket it by 10-year ranges. And what you see on the slide, or once you lay it out, it is very clear that participation in these retirement accounts is past its peak. So we haven't been able to get more Americans saving into this retirement system. If you think about it, an investment trade, right? That's entering the accumulation period. Now, what happens when you get to the distribution phase? Well, that's kind of scary. But you see here the peak in retirement account participation, across all age groups, really hit an inflection point like between 2007 and 2010. So the GFC was a kind of a critical moment. I know in our lifespans, it feels like it was a long time ago, but you go back and read these episodes in history about prior equity bubbles, sovereign wealth bubbles. Like these take a lot of time to play out. So 15 years here is really just almost a blink, like in the scale of the phase of the system. But like right now, the system looks for the retirement accounts. It looks like we've hit that point where this pillar, that policy has become reliant on, that savings has become reliant upon for the American households. We've passed kind of that point of no return, where now the second order effects of getting people employed at companies where they can save in a retirement savings plan, that's kind of fallen. And I say that it's pretty clear that like policymakers are aware of the problem at this point. So in 2019, December, before we even got into COVID, you had this big push to pass the Secure Act. It's another great Washington D.C. acronym, and it has a great one. I don't know what Secure stands for, but it's very clever, almost comedic. I mean, it's just good marketing, right? Because it's not secure from a standpoint. But it was an attempt to kind of band-aid onto this problem and structural decline. It obviously was a band-aid because you just had Secure Act 2.0 passed 3 years ago. So the fix is, the holes in the dike, if you will, or the Dutch boy plugging the holes in the dike. They're coming faster, and the kind of the timing between those attempts is just their hands are being forced to resolve issues in this kind of framework. But Secure Act 1 tried to fix this by expanding access to retirement plans. So maybe not 401ks, but like simple IRAs or stuff like that, approaches that let either individual workers, what do you call those? Like self-employed.
Self-employed.
Yeah, right, exactly. Start up kind of a government saving or government tax favored retirement savings plan, or it expanded it also to part-time workers. So this deal was never part of the kind of the bargain between employers and the part-time work help. But as you've seen a shift, full-time employees, full-time employment numbers kind of topping out, more workers, falling into part-time work. This act kind of treated as like, well, we can reverse this trend by, lowering the criteria to be able to participate in one of these plans, and that'll hopefully pull this participation back up. It also pushed they call it the required minimum distribution age. So basically, it's just a forcing point for when, or it gives you the ability to work longer, right, without having to take mandatory withdrawals from your retirement account. So it pushed that age to 72, right? So the answer here is just you can resolve this problem if you're an American household by working longer. And I don't know about you, but by the time I'm 72, I'm in my
to be chilling.
Yeah, and you're also spent. Like it's hard to work. I imagine it's hard to work 500 hours a week in most jobs at age 72. But that's one of the key answers right now that policy is throwing out for this system as it's going through these issues. You're seeing the same thing, or similar across other kind of G7 countries, other developed economies. France, this thing with the yellow shirts, and Macron trying to pass this mandatory age limit, and people don't like it, obviously. They increased the max contributions for 401k auto enrollment. It's basically just save more, plow away more of your savings. This as we're going into kind of an inflationary impulse where household disposable income and savings are squeezed. It sounds nice, but in practice, it's hard to do. And then 4 is increased tax benefits for small businesses to launch a retirement plan. The thinking is, well, if you get all these small employers to launch this, there'll be more access, and that was the problem. Go ahead.
I was going to say the explicit intent with something like the Secure Act and Secure Act 2.0 is to increase the participation rate in these retirement accounts. But is the implicit sort of acknowledgement is that they need the flow of those dollars into these assets to keep them elevated in value?
I think so. From a standpoint of keeping I call it a credit bubble, right? Mm-hmm. Keeping the bubble going. The actual size of the dollars here, this is actually a silver lining, I think, for the American household. The scope and scale of what the households actually own here in terms of the entire credit pile or the equity market cap, it's relatively low. So total 401k assets, call it $6 to $7 trillion, right? Somewhere in that ballpark. Equity market, it's probably about 35 trillion. And then the bond market, tradable QSIPs, and that's pretty much what all of these. QSIP is just a bond that is, a registered security, and it trades publicly. When I use that term, total QSIPs outstanding, I think there's, easily 45 trillion total credit outstanding in the U.S. Like just measured from the Fed's perspective is in the $90 trillion range. So total assets here in 401k plans is 6 to 7 trillion. Households own a small sliver of the entire bubble, so they might be a marginal buyer of dollars and financial assets, but they're not holding the bags. So that like the good news is, if this is a generational bubble, which I think you look at the charts and you don't know it while you're in it, you won't reveal it till we write 5 more chapters and we're looking back on hindsight. We go through some numbers here towards the end. There's a slide. I think it's pretty clear that the financial asset bubble is similar to what other societies saw in the past. UK with was it South Sea, France with the Mississippi Company, Netherlands with Dutch East, et cetera. Like this looks a lot like those, but from the household's perspective, their bid into financial assets and 401k, it's really not holding up market cap. They're not the driver. They're just there because it did work, and then the policy, my interpretation of it is, hey, let's funnel them into what's working, and then also let's do it in a way that works for American corporate balance sheets, et cetera. Now, this is just household balance sheets. You look into like public pensions, including like things like CalPERS, state of Illinois. You have some municipalities that are in trouble and funding their pension obligations through municipal bonds, right? So you're paying your pensioners by taking on more debt. Now that's a problem. And then I think if you dive into Social Security, it's in a similar situation where you got the number of workers paying in, hitting a transition point where workers paying in is much less than workers drawing from the system. That's a problem. But in terms of just asset ownership on the bubble, I think it's actually driven by international, like the data. This is a different time series than what we're looking at here. You look at like the treasury auctions and stuff like that. It really looks like the international bid for the dollar and dollar assets is driving up the stock and bond prices. So The good news is I think there's a really a silver lining opportunity here. 50% of Americans owning, the housing stock at, ultra rich valuations, and same thing with stocks and bonds. Like, we can get hurt, but we also have time to make this transition and save a lot of starfish. I don't know if you know that analogy. It's like the starfish on the ocean. You throw it back in the water. Well, I saved one. There's a lot of good I think we can do here, collectively. I don't want to fall too much into the black pill. Like this is
a white pill episode, freaks.
100%. There's a problem, but and there will be damage. It will be painful for a system going through transition, but I think there's a big opportunity here, and relative to where a lot of countries, other economies are. It's not great for anybody, but for America, I think we do have an opportunity to make a nice flip. But my answer there, going back to the Secure Act, I don't think this is the big kind of tectonic plates moving here. I don't think this is something that just legislation is going to be the solution. And it's very clear, like you put an act out, Secure Act 2019, now we need 2.0. It's kind of the same thing. You've seen in a lot of the different big spending bills, touching on retirement savings. So I forget what one of the 2021 congressional spending acts was called. There was Inflation Reduction, there was the Affordable Recovery or something, American Recovery. I think it was the American Recovery Act, but it included a bailout, like $900 billion, almost $1 trillion for the central states pension plan. So all these just collection of American businesses with failed pensions were kind of bundled up into one vehicle. And we needed part of one of these spending bills was bailing those out. And you think about, or if you read about how this pension, there are like these thousands of pensions got here, right? And once they were bundled up, this kind of like managed oversight of this vehicle was operating. They needed to hit like a 7.6% return target. I don't know if that's like to the decimals, but like all these pensions structure themselves like you got to hit your 8% bogey, right? That feels possible in a 3 to 4 year bull market. What they realized was like a 5.2% IRR, or maybe like 5 point, something like that. It was an IRR in the fives, which I mean, relative to historical norms and asset returns, that's not bad, especially given a certain level of risk. But it just tells you like the difference between hitting a 5 versus your 7 or 8 bogey is insolvency, and you need a sovereign bailout. It really tells you like this is a system that it's pushing up against its constraints. It is now struggling to deliver after 30, 40 years of bull market. And then the answer, I think, is it's like, think about the analogy of like a king in the Middle Ages, and like this, the problem shows up, in the keep of the castle. If you're decentralized, or if you're other lords, your institutions, whatever, if they can't deal with it, well, now it's your problem. Now it needs to come onto the sovereign balance sheet. That's kind of what you're seeing here with both pensions and then exactly this, the retirement plan. So we're trying to band-aid it with Secure Act 1, 2. I'm going to go out on a limb here and say I'm not convinced like 2.0 got it done. Like we'll be back here, and there will be another kind of like sovereign action, like it rises up ultimately to the sovereign balance sheet.
Yeah, 3.0 will fix it.
I think so. I think they got to figure it out. Third time's a charm.
Yeah. Well, that's what, like, as you can see, I'm looking at the notes you sent me. Let's give a shout out to Matt here. I think you are the guest that has sent me the most detailed prep notes for a show in TFTC history. And I've been reading through them the last few days, and I think one of the big drivers of sort of this passive investment model and this problem that we find ourselves in is the structure of these funds. So I think we can dive into like stable value funds and target date funds, like defining what they are and how they've really sort of driven flows into particular financial assets over the last 5 decades.
Yeah. Before we do that, I put this third slide in there on the housing. I think this is a key point to make. You see the same crack showing up in that other pillar, the primary residence. So that is in decline. Make sure we hold that thought. So we go back to target date funds. But primary residence, you're in the same ownership decline here as just retirement accounts. So the problem is getting more of the middle class in, and this is kind of part of the broader theme of headlines you see in the 2010s, right? This isn't something new. Like the American middle class is struggling, and at this point, the policymakers all know it. But when you look back on what happened in 2020 and 2021 on the fiscal and monetary policy just flood, kind of makes a little bit more sense, right? Primary residence is the pillar. If we start seeing a contraction in home prices like we did in 2008, the problem just becomes worse, like you enter a gravity well. So put a chart here on the right, or a table of the QEs, and you break it out between treasuries, agency bonds, and then agency mortgage-backed securities, right? Mortgage-backed securities are just bundled pools of like Fannie, Freddie, Ginnie Mae home loans just rolled in. In the last QE, it was actually more agency mortgage-backed securities, like 2.9 trillion versus treasury bonds. I think, you know, the Bitcoin Twitter memes, like we obviously see the money printer go burr. We think about it as treasury debt. But it was actually the agency MBS, $2.9 trillion of new issuance. So you see in the data here, the housing market in 2020 and 2021 was essentially subsidized by the Fed. I think they bought like 85% roughly of all agency mortgage-backed security issuance.
85?
Yes. Like that's, in Bloomberg, you can scrape all QSIP. So I put together these numbers myself. That's my own number, what I see on it. But I think it's about 85% of agency mortgage issuance. So the jumbos, I think it's like 750K. Don't quote me. I'm not a mortgage industry expert. So the Fed didn't buy the jumbos, but the agency mortgages, like your bread and butter conformant loans, that gets packaged and pooled. Wall Street ships them out to the world. Yeah, Fed bought 85% of the 2020 and 2021 issuance. It's just shocking. Like,
it's all inspiring. That's what I was going to say.
It truly is. It truly is. I mean, now we can just get into another side tangent here. Just interesting points. They're obviously not. They're in QT mode right now. They're forcing private balance sheets, so banks right now. You can still buy agency mortgage-backed security issuances, but they're going to be shipped to private investors, and this is where everybody's kind of seeing the charts of mortgage rates, right? So the jumbo rate is now above 7%. Your agency lending rate is going to be lower, like I say, like 6 to 7. But right now, kind of the housing stock, this I don't call it a bubble, is being kind of fed or like forced onto the private balance sheets to absorb new mortgage debt at a 6 to 7% coupon. So what it amounts to is the borrower, who is going to be typically younger, buying their first home, the bottom of this pyramid, the less than 35% group here who is struggling with home affordability, right? You're forced to buy in now after the Fed has pulled back from subsidizing. Now to get your first home, you're forced to buy in at a 6 or a 7% mortgage rate for 30 years on the same house, most likely. Your entry level home is probably not going to be the brand new construction. So it's kind of an interesting moment here. What's going on in the grand scheme of things. So I don't know. I just thought that was interesting here. That second pillar here, the same way QE is supporting the financial assets. It's like, no, it's also supporting your other pillar too. It's supporting your primary residence. So that $2.9 trillion, that's a shocking number here once you understand it in the grand scheme of the housing industry.
Yeah, it just edged out treasuries. So if you freaks can't see it on the box on the side, March 2020 to March, so the COVID stimulus, they bought 2.916 trillion in treasuries and 2.926 in MBSs. So that's 10 billion more in MBSs than treasuries, when everybody thought most people thought they were predominantly buying treasuries.
It's truly awe-inspiring that you use that word. So I think, we were going to get into the talk about target date funds, and then there's another niche that I specifically focused on called stable value. But target date funds are, basically this kind of new financial product that started showing up, I want to say in the early 2000s, but they got their kind of like anchoring in industry regulation right in 2008. So April 2008, the Department of Labor issued this ruling for they call it the QDIA, Qualified Defined Investment Alternative, I think is the acronym. But basically what it means is it's the set it and forget it, the default option for when your new employee signs up or whenever you start a new retirement savings plan with your employer. So it used to be, you could just plug them right into the equity market, or you could save them in. I'll talk about stable value here. It's just to lead the story here, it's like a niche money market account. It's got some specific problems with it at this point in its history. But the target date fund is essentially just a passive investment mix between stocks and bonds. And it sounds like a nifty, clever product, but basically it just foots to the heuristic own your age in bonds. So the idea here is if you're younger, you should be willing and able to take more risk in your investment profile versus if you're older, you're in retirement, you're 65, 70, 80, et cetera. You have less time horizon. The money is more important for you. You're more dependent on the flow for your investment or from your investment portfolio to deliver your what you need. Your food, your rent, your healthcare, et cetera, to live. You don't have a paycheck, so you're totally dependent. So in that aspect, you shift towards more bonds.
Less risky assets.
Less risky, correct. In what you're going to talk in financial academia with the CFA curriculum is going to test you. Yes. Lower risk. And as you have an aging kind of population, what happens is, if your median age is trickling up from, hey, we were a young country back in, 1982, as we came out of the great inflation, now, you have lower population growth, fewer births per household, you age, and then the investment mix then will shift inside of this pool towards fixed income, bonds. That's really where you land yourself, right now. Like we're in this little window where you've got the biggest demographic exit from the American workforce, and every developed economy now is kind of hitting this at the exact same time. You look at Western European countries. Japan hit it way before everybody, but we're all like seeing this kind of transition point at the exact same time. So we go into a slide here. This is just an example of a target date fund. So this is Vanguard. If you go to their website, basically just to describe the chart for the people listening on audio, you've got age on your x-axis, so it cranks up from 20 to 95. And then on the y-axis, you've got your investment allocation. So if you picture a portfolio with 100% that you invest, when you're young at age 20, Vanguard says like 90% in U.S. stocks and international stocks, 10% in U.S. bonds, international bonds. And then they also add some tips here at the end. But basically, it just kind of glides down. They call it the glide path. You lower that mix from like 90, 95% stocks down to, they call it on theirs 30%, let's say, by the time you hit 72. And that's it. And this has been like the big industry push, probably like the biggest product in the retirement space. There's a little bit of, I guess, nifty stuff that you'll hear people talk about at conferences. How do you get the auto escalations up, all these little things. But like TDF has been the biggest product, and it's just this own your age in bonds rule. And that's really what we're riding on.
Yeah. Yeah, it's just a lot of groupthink. I think that's how I would describe it. again, it gets precarious because when you have a material amount of people riding this particular model of investment strategy paired with the demographic situation and paired with the rates. So that's the one thing that scares me as an individual who has many loved ones who are entering their retirement age. We're looking at a Fed's fund rate above 5%, potentially going higher. That's having a very material effect on the value of the bonds that have been shifted to a majority or a large portion of many people's portfolios as they're about to retire. So the last 2 years of Fed rate hikes have completely borked this model, have they not?
So I would, my kind of mental model or like framework for understanding the system, you know, as you learn more and more about this, I think the Fed is less in control than we appreciate, and that's actually like the market is in, like the bond market is in control. So the sell-off in the bond market, and I mostly just watch like the U.S. dollar denominated bonds. I'd have to go back and check the dates on the sell-off. Let's say the the Euro bond market, or the JPY bond market. Those didn't time exactly the same way, but the U.S. dollar bond market has been in sell-off since August 2020. So you think about, like, we put the mother of all stimulus into this thing. You know, $6 trillion of QE, $6 trillion of fiscal stimulus. That put the bond market in a rally basically from just March 2020 through August of 2020, and then it's been selling off since. We'll see how this goes here. Like the bottom on the chart right now is end of Q3 2022. So last year when we had the like the big event was the UK asset liability mismatch. Hey, it was pension plans again. Go figure. Creating this unwind. After that, there's been like 9 months of, you know, it's been windy, but it's recovered. You know, my answer here is like I don't think it's the Fed that's actually responsive in creating the market sell-off. And if you go back and look at the tape, you know, the Jackson Hole conference in August 2020, they thought the problem was actually going to be like systemic deflation. And they said, yeah, we'll get a little bit of inflation, it'll be transitory. But you've just seen the opposite. Like they were caught off guard, I think, as you know, the inflationary impulse was much stronger and surprising than they expected, and they've had to kind of catch up and kind of roll back their playbook, if you will, on, you know, how the system works. So you kind of could see this in their quotes they were giving to the media last May. You saw like Janet Yellen making statements like, we didn't fully understand or grasp the inflation or what was going on. So they were behind the eight ball, I think, in terms of understanding the real system dynamics and what was going on. This is an insanely complex situation. Like once you get under the hood on how the bond market works, there's so much going on, and it's tied extremely closely. If you look at fixed income markets, credit markets, like all the investment banks structure them into groups like FICC, they call it, fixed income, commodities, and currencies. And this plays into the bigger picture of what's going on in the grand scheme of things in the global economy. That's a huge can of worms to unpack. We're just trying to focus here on how does the American, you know, middle class household get through this thing, preserving as much as possible. But if you think about like the Fed was wrong footed, they've had to hike rates and, you know, give that incentive to pull dollars in to savings, like for, you know, front end low risk you know, investments and currency IOUs. If you think about it, that's kind of good for a 65-year-old, you would think, right? So let's say you saved up and you've got, let's say, like the median account balance, something like 150K in your retirement balance. Like now I can shift that into a money market fund, and I'm gonna get 5% right now. That sounds like it would be good, right? But not everybody did that right away. Like positioning doesn't happen. Like by definition, the entire kind of like group isn't going to be in the right position before the trade. So that one, it caught them off guard, and we'll go into like the actual results here for these target date funds in 2022. Yeah, I think it's just a tough environment too. Like I'm going to be pulled into 5% money market rates. So it's like, how long do you think
That's
that 5% stay there? Yeah. Or it could be, is that actually going to keep up with your future consumption needs? And I think, consumption gets a dirty word. It's like, it's not going to the mall and buying, new shiny clothes or taking a fancy vacation. Sometimes it's just like your food, your healthcare, and your rent, right? Your basic life needs. So yeah, it's insanely hard, I think, for a 65-year-old or a 70-year-old to kind of like plan their life and then their savings in this system around whatever is coming around the corner over the next 5-10 years and what they're entering into.
Yeah, you shouldn't have to worry about it either. Like, you're talking about like the average middle class American. They just go to work, they do their job. It's something Bitcoiners have said ad nauseum over the years is like your average American saver shouldn't have to have a vast understanding of the intricacies of the financial and monetary system to make portfolio allocation decisions on the go to ensure that they have money when they go to retire.
Mm-hmm. Yeah. And even still, I mean, we treat Bitcoin for what it is. This is the project to be building on. This is the long term. We're building the cathedral here, if you think about it that way. This is something that's going to pay off and build a system of, resilience. But even if you think about a 70-year-old with a Bitcoin allocation, like if you bought or you built up your allocation and let's say like 3-4 years ago, you're fine taking what happened to your portfolio in 2022. But that's not the way most markets actually work in terms of like forming a trade, right? Most people, enter a trade on the run, like as the exit liquidity. So you started piling into this trade as a 65-year-old, and there were probably are definitely examples out there, people who did this, like they heard the narrative, 2021, it made sense to them. I need to buy Bitcoin. They probably, like, if you bought it 40, 50, 60K, like now after what happened in 2022, you took the drawdown and now you have to have the conviction to stay in that trade. And it just tells you, like, even if you are thoughtful, you think about this, like this is really hard for a 65 to 7-year-old, like to solve this problem. Yeah, as much as kind of the narrative goes, like there's what's called like an age clash going on, I think, in American society right now. Like young people resent boomers for pulling the ladder up on the way up. Boomers resent the younger generations for not having the work ethic that they, I'm just speaking, painting with a broad brush. But it's not easy. Like just speaking from, I guess I'd call myself right in the middle of those two things between the young and the old. It's not an easy environment, I don't view, to be, 65, 70 and trying to plan out the next 10 to 20 years of your life into. This is a massive challenge building on top of this kind of shaky foundational system.
Yeah. Should be easier. Should just be able to save money in a good asset.
I love that. Yeah. But like building the bridge to get there is, I think that's the work to be done.
Yeah.
Hopefully we can talk about that later, but I got hopefully only 1 or 2 more slides we can go through here. But the key thing is these target date funds, the way they work is you'll set your target retirement date. That's where the name comes in, and you'll have a year, and the industry, every investment manager will bucket them into like 5-year buckets. So you have a target date 2020, you have a target date 2025, you have a target date 2030. And then as the employee in this plan, you'll just have to choose. You're like, all right, how old will I be? What year will it be when I turn 65? I was like, round it, the closest 5 years. Like that's my mix. And then you're just going to get whatever was on that glide path chart for your mix. So how did these actually perform in 2022 when it was like time to deliver? It's like things that sound great in practice, or they worked in your back test. In reality, once your plan meets, it's kind of like the Mike Tyson fight. Everybody has a plan until they get punched in the face. It's kind of that in 2022, right? You saw everybody exit, came after that, boomers exiting from the workforce. I think it's like 10,000 per day are retiring, which is just a crazy number to think about. And then you saw kind of the exit hangover from the 2020 and 2021 monetary and fiscal policy. Saw this massive pullback for these near-dated retirement funds. So I bucketed these in Bloomberg. There's no good benchmark here. And that's part of Secure Act 2.0 is now we're going to get benchmarks on these target date funds, and that will supposedly help fix it. It doesn't change anything from my opinion. But you just bucket these funds into like just kind of 3-year groups, 2016 to 2020, 2021 to 2025, and 2026 to 2030 for these target date funds. You look at the chart and they all perform the same. Everybody's doing the same glide paths. You're just going to get the plain vanilla, whatever's off the shelf. And what we actually achieved at the end of the day for 2022 for this, this was like the biggest development, I would say, in the retirement savings plan kind of industry, and also pushed by the Department of Labor with this QDIA rule in 2008. Where the rubber meets the road is like the year that it mattered. These near-dated target date retirement funds lost, like, this is just measured like 12/31/2021 to like end of April, lost 1/5 of their purchasing power in that time frame. So big hit. Like that's your number 2 nest egg. Your home price is still holding up. You got that, but you just lost 1/5 of your purchasing power in 15 months. And this is what needs to, you're counting on this for like your remaining time horizon. It's
scary.
It's, yeah.
Inflation, it's only transitory though. Don't worry. It'll be fixed.
Yeah.
And so is there a recognition in the target date fund industry, if you will, that this isn't working? Or do you think they're sort of hoping and praying that we'll have a reversal here? This is just a temporary downtrend.
Yeah, good question. I think that is the default kind of mindset. Hey, markets sell off. You got to buy the dips, be in it for the long run. Stocks go up and to the right. Bonds have worked for 40 years. I think so far the general mindset, if you show up at an industry conference, it will still be like, markets recover, this happens, stay the course, stick with your plan. I would say that's generally where things line. I haven't seen anything. There's a couple of big industry trade groups. I know, I've been focused on going to the Bitcoin conferences lately. We're seeing each other a lot, met a lot of great people. But as you go to these retirement conferences, the new kind of approaches, what do we do? What do we change? There's nothing that stands out to me as particularly innovative or that changes these are tectonic plates moving at the base level that are driving these trends. You're not going to solve this on a piece of paper, or some industry consultant comes out like, hey, you need to put commodities in this fund or whatever. It's like, I don't know, like I just don't see that being as kind of transformative to get out of this problem. But right now I'd say it's in like the general mindset is in the middle of like some like like they're shaken but not broken. I would say they still think this model isn't under like systemic threat. or systemic decline.
Yeah. And you would argue it is.
I think, if you really look at the data and you take a long-term time horizon and you take the collective body of evidence, I think, yes, this looks like build from first principles. This is a monetary system that's, maxing out on its end of life. And then this retirement plan kind of complex is built on top of that. Same thing with your insurance sector. It all plays in on the same things. So I think, part of it, who's the quote sometime, it might be Keynes. Sorry to mention this, but he's like, it's hard to get someone to understand something if their livelihood depends on it. Mm-hmm. I think if you go to the industry, you go to these conferences, like it's still slow to absorb and realize we don't just need something status quo. We need to innovate, from the studs, from the foundation up.
Yeah.
Sure. And I think you see that same thing. I talked about the industry. You go and talk to retirement professionals. There's asset managers. There's a whole consulting industry built along this where employers don't. They're in the business of making widgets. Providing goods and services into the economy, and they're just gonna follow best practices of what the retirement savings plan consultant says. And I think the same thing from like a politician or a policymaker. Like they're just going to take advice from who they trust. And I think right now they're still built up, they're still plugged into this industry where they think they can, they think someone else still knows the answer. And I think it's similar to what you see in the energy industry, all these other industries we're going through, and how government responds to structural issues. We're still at that phase where, the king is still listening to his existing council until things continue to decline, and you got to pull out and start listening to new people. So I'd say we're somewhere in between those two settings.
Lovely. Well, let's give the freaks the white pill. I mean, that's why I'm excited to talk to you, because you have dove deep into the data. You've painted the picture very clearly, not only during this conversation, but in other conversations I've had with you. And you think that there is a place for Bitcoin to help smooth out the proverbial landing of this plane, particularly with the retirement accounts of Americans. That's why you build.
100%. Yeah, exactly. Build. The only way out is to build the future. So if you look at it from a standpoint, I think what, you hear in the Bitcoin chatter, in the space, it's basically we're thinking about this in terms of how do you get more and more people to own Bitcoin, right? And if you look at an adoption curve, where are we on the S curve? You probably have a better guess than I do, but like true people who see this as a store of value on their own balance sheets, 3%, 5%. That might feel high. It might be 1 to 3%.
I was going to say 1 to 3. Yeah.
Yeah, 1 to 3. I'd probably ballpark about there too. And Bitcoiners essentially already intuitively feel this. It's like you describe it to someone, you explain it. Half the people might just,
zone out.
Tone out, pound sand. We're not going to listen. You might get interest or curiosity from, I don't know, another big group, but they ultimately don't do anything. They won't act on it. And then it's just very slow. You're very slow to pick up new people into this transition. And that'll continue to happen, right? You will continue to see adoption here as people are pulled in by the kind of those first principle values. All the freaks know this, right? Like, why would you choose this money versus other money? Like, very familiar with the value prop and all those use cases that Bitcoin delivers and uniquely delivers. That's why you think this adoption continues, right? But in the big picture, you've got to do some sort of transition. We talked about, if you're going to transition the middle class, you've got 50% of people totally dependent on their primary residence and just financial assets in their retirement account. How do you smooth that out, right? Because this is going to be a messy process, right? It's already kind of obvious. Like, just picture where we're at, like, mentally. Like, where were you 18 months ago? How did you feel about financial market? Like, how, like, everything that's taken place, the geopolitics, everything. Like, this is just an extremely violent process to go through. Like, this type of, potentially what we're facing is a monetary transition. And it's not all going to come smoothly, right? I think everybody kind of sees that happening. You'd hopefully agree with that. And,
Yeah.
and I think history's playing, like, live reality is playing that out. But I think from my perspective, what I've tried to do, and we talked about build, why did we found this company? We saw this problem there in the 2010s. Once you put 3 QEs on the board and you saw the slowness to respond, and right about that 2015, 2016 election where, it was very clear where something had changed. China was doing a massive currency devaluation. What else? You've been through 2 sovereigns. So you had a U.S., I call it the GFC, was a credit crisis, and then you had the European credit crisis back to back. It's like, oh, we gotta start figuring some of that. And I'm talking about what we started here at Build. We took the approach of helping that middle class transition out of this from the perspective of kind of resolving the problems in their fixed income allocation. And that's we talked about it, the largest kind of asset class in your investment allocation that the financial industry is going to push you towards once you hit that kind of like 65 retirement age bucket. You're going to skew into bonds. So for better or worse, that's where kind of me and my co-founder chose, like, we're going to try to solve that problem. And in the from our early days, like, our foundational kind of approach was, okay, if you have to own bonds in this mix, and that's the only way you get in the door, right? And, like, through the consultant, gatekeepers, through the regulations, you got to have a target date fund mix. You got to have all these things. It's like, we got to meet people where they are, right? So that's, let's solve the bond problem, because that's really where the rubber meets the road on a currency that's or a monetary system that's entirely built on IOUs. If you're holding those IOUs, let's try to save you there. So our firm, we launched our first investment funds in January 2020. We got out, after going through all the regulatory red tape, becoming a fund manager. This is not an industry built for startups to compete, right? It's a huge amount of gatekeeping. Like, it's unbelievable, the amount of compliance and overhead, and the good thing too is it's also proof of work. Like, you have to have a track record to compete. So they want to, if you're being evaluated, right, as a fund manager, as someone who's going to manage other people's money, you have to have that kind of time series of, here, what did you do? Did you deliver results? So it's kind of aligned with Bitcoin in that way. The proof of work aspect does stand out. But it also, in that sense, though, it also kind of like, it puts the incumbents in a seat where, well, by definition, they've got the longest track records. They delivered in these bull markets. And for the most part, you're not going to see kind of like broad or complex thinking in terms of how investments are going to be positioned, especially from the employee. You don't understand the big picture of financial markets and what's going on. That shouldn't be your day job, because your day job is making goods and services, right, to provide into the real economy. But what I was going with there is, like, even in the consultants, like, what you look at is the history. It's like, what did you do? And if you had this great bull market. Well, until something goes otherwise, you're just kind of going to assume on that. Say here, it's proof of stake, in that regard. Like you can't get in the door until you've done that proof of work. So on that point, we built out kind of an approach. If you think about this, every time you get a monetary easing, what happens? You see the Fed or any central bank buy a lot of bonds or absorb a lot of bonds or do the cash swap, take bonds onto its balance sheet, inject liquidity into the economy. What happens? You see risk assets go up, right? So our first kind of suite, I would say, of products in this space to compete in the fixed income market was built around that concept. It's like the duration trade. If you look at the bond yield chart, going back to early 1980s all the way to 2021, when we went from a Fed funds from 20% to zero, duration really carried you, right? As a bond investor. Mm-hmm. Yields go down, your prices go up. So as the system goes through these issues and you have to keep lowering rates to like continuously bail it out, it actually makes asset prices go up, both bonds and equities, right? But in bonds, you don't keep up with the risk profile every time that happens with what you call just risk premium of risk assets. So it could be the S&P 500, it could be tech stocks, it could be it even shows up in like high yield credit, right? High yield credit behaves like a stock. But basically this first round of what we launched, we were like, let's keep up with that. Every time we get an easing, let's let the bond investor, instead of having to just absorb, I have a two duration fixed income portfolio. If rates go from 2 to 1%, you're not going to get that much of a lift. And, a lot of these investment portfolios that your 65-year-old retirees are kind of migrated or shifted and allocated into from the industry perspective, they're not getting the full benefit of what policy was doing, right? So that's what we launched in Jan 2020. We were one of the top performers in investment grade intermediate bonds, which are like the core building block of I would say the bond market and these investment portfolios. Especially as you get into this near retirement kind of age cohort. Problem is the inflation, and then also this massive sell-off. Despite being one of the best performers and like accomplishing what we were setting out to do, we might save, let's say it's like, instead of a 1/5 drawdown, it's like, well, if you don't draw down at all, that's a win. Well, then you take the inflation charge, right? As that 65-year-old. So by like 2021, 2022, like the inflationary impulse was there. The sell-off was already well underway. I started to realize like this isn't going to get it done. And as you see these two things working in parallel, I've been working on this project for, I would say, like the greater part of my 30s. Like it's been a while. What we're doing, trying to save the bond market. In parallel, you've got what's going on in Bitcoin, and I've been, longtime TFTC listener. Been involved in the space, and I think after the cycle, I would say, 2016, 2017, that was the point where I saw we actually had really good people in the Bitcoin space just describing the monetary system, like you and Matt Odell included. I don't want to name, just add incremental shout outs up to there because I'll leave someone out, but there are a lot of great people along the way who helped me put these just kind of like two parallel streams together, and you kind of see what's going on and where the leapfrog can happen. So anyway, about 2021, I started reaching out to figure out how do we get Bitcoin involved as a solution, right? I think Bitcoin, the community, and it's pretty small where the business development is going on. You see what like Strike, the custodial solutions like Unchained, et cetera, like your 1031 portfolio companies, they're really doing an awesome job building out this kind of nascent, developing, new monetary system, like just from the ground up, like building. That's obviously what I love. It's the name of our project, name of our company. But in parallel now, what I've tried to start thinking about is how do you connect those two systems, and the people who are at the middle class who is primarily invested in these, the legacy framework of kind of this parallel system that is in structural decline. How do you bridge that gap? And when you think about what this kind of entire system is built on, the legacy monetary system, it's just dollar credit IOUs at the end of the day. The dollar system is insanely complex, once you think about it, or if you try to map it out, repo markets, swap lines, what's the Fed, counterparties, dealers, treasury, like all of this stuff. But at the end of the day, it's dollar IOUs. And that's what these, the bulk of people in the middle in America, besides their primary residence, that's what they're invested in. So my thought here was, all right, you got to find a way to bridge them into Bitcoin. Not a lot of them are just owning Bitcoin on their balance sheets, and even aside from that, owning Bitcoin in a way that is, self-sovereign, taking it into their own custody, all of that. Like we see these problems going on, like as we go through this transition. But the idea here is, you've seen a lot of great kind of thoughts put out into this space since, I want to say, I'll give the shout out to Nick Bhatia. I think in 2016 or 2017 was the first that I knew of to describe this as like a collateral layer, to Bitcoin as a hard money ledger to back up as a a collateral for dollar lending. And that's just a slow moving process of everything that's been building in my head as I'm thinking about how do I help save this the retiree. And you map these onto real people. It's our parents, it's aunts, uncles, coworker, people in our community. They're invested heavily into dollar IOUs. So the thought is, if you bring in Bitcoin custody or Bitcoin into that dollar IOU landscape, can you help bridge the gap? And this led to conversations with people like, I would say Parker Lewis, just to give a shout out at Unchained, and everything that Unchained has developed from the back end custody model, as well as their servicing operations. They led the way on, from my perspective, like a lot of companies were entering the space on, I'll just like blanket here, they call it like crypto lending, and just garbage approaches where they just rehypothecate, layer collateral. You see the same effects with daisy chains that you see in the existing like repo market problems. And all of these guys, like, I don't want to say all, but like you've seen just massive amounts of failure. So while it's viewed as like tremendously risky here, to build this dollar credit foundation on top of Bitcoin, meeting with this team at Unchained and everything they built, shout out to Joe Kelly. I could just name up and down the list of, the really solid people they have there, the team and what they've built out on the IP. But mastering that Bitcoin back lending. And just to briefly describe just the profile here of, from a supply side, as a provider of dollar capital, you've got, you're looking at the entire landscape of credit to invest in. You got treasury bonds, the risk-free asset, if you will. I don't want to go through why there's hair on it. You've got corporate bonds, you've got securitized debt, and then after that, you're getting into just other stuff. And in a bond market where you've got the largest sell-off since, I want to say like 1931, like it's basically the Great Depression had a big sell-off, and then you had a big sell-off at the tail end of the Revolutionary War. What we saw in 2022 was like on par with those. So you got to choose, like, all right, if I'm going to save my investors in dollar IOUs, because everybody's still piling into those, like as an asset manager, and this is where my day job comes in. not wearing that hat, as we're talking right now, but when I wear the hat of CIO for our investment manager, like my job is to choose what is going to be the most performant fixed income, dollar IOU at a perceived level of risk for that investment. So if you look at what Unchained is built out, when I saw this, we came to that aha moment. You see on their loan profile, like you see a lot of these loans going out. I want to see them going out to Bitcoin companies for one. Like I want to see it going out to entrepreneurs who are providing goods and services into the economy. So when we talk about this, what I don't want to see is people levering up their own balance sheets, posting their Bitcoin to buy more Bitcoin. Listen to RHR, listen to Matt and Marty, folks. Like, stay humble and stack sats. Do not use leverage. Like, you will get taken to the wood chipper. You're probably not, a savant trader. Like, you most likely will deliver pain to yourself and your portfolio. Just, I would say, stay away for most people. Humble advice. But when you loan into the Bitcoin economy, you loan to the Bitcoin entrepreneur. I like to think about this. I picture this. I want to see businesses collateralizing their Bitcoin on their balance sheet, using that to obtain dollar capital, go out into the economy, create the goods and services that our community, the market, our parents, siblings, neighbors, etc. need: food, rent, energy, etc. So if we're lending out, and this is where the Unchained loans come in as the profile, they're like a 14% nominal yield or APY on those. They're average is about a 1 year duration. And then the backstop, they're about, we say 40% loan to value. So if you have $250,000 in Bitcoin, basically that's going to, just give or take, you're going to be able to pull a loan of 100K against that. So from a lender standpoint, you really like that. You like that mix. In an inflationary environment where CPI is running 7, 8 at its peak last June, and this thing's going to be, my opinion, we're probably going to be in a volatile kind of inflation cycle. We got one impulse last year. You're going to keep getting these. But to have your dollar IOUs kind of maintaining their purchasing power, you're going to need that high level of yield shield, right? Let's just say right now the 5% treasury yield on the front end, I'm not 100% sure that's going to get it done. A lot of people are, flocking in as that rate kind of attracts more people. But in an uncertain future, you see a system getting more and more volatile. You don't know. So the bigger you build that shield, I'm speaking on behalf of like a fixed income or credit fund manager, the higher that yield shield, the more likely you are to kind of and maintain purchasing power of those dollar IOUs. After that, the 1 year kind of maturity, basically if you think about this, you structure this as a pool, right? And you've got many loans behind a one to many fund, right? So say on average, you've got half a year, right? Because you have some maturing tomorrow, you have some maturing a year from now, and then they'll just kind of wind down between one day at a time. On average, you got a half a year duration. Rule of thumb, you hear that metric duration. You talk about it in bond portfolios. Basically what it means is, say like your duration of your portfolio is 1. It means like what's the average length of all the maturities, all the cash flows in the year? When does the average come in? So if you say a duration of 1, it means barbell 1 year, or sorry, a bullet 1 year. Your fixed income portfolio is basically balanced right there. So your duration is this metric where it tells you, let's say you have a duration of 1. It means that if interest rates rise 1%, they'll go down. Your value of your bonds will go down 1%. So same thing, it's just 2. Duration of 2 means interest rates rise 1%. Your bond portfolio value is going to go down 2%. In a rising rate environment where we had this just massive sell-off, in 2022, duration's not your friend, right? Versus in the environment where rates are going from 20% back in 1982 to zero in 2021, you love duration. Like it's gonna carry you. It'll be a volatile process, but it's gonna work in your favor. No crystal ball is perfect. The future's always uncertain, but imagining, like just saying, this next phase is potentially looking at an environment where rates are want to rise as opposed to just structurally come down. Duration is not going to be your friend. So this loan pool, and then on top of that, you've got something actually backstopping, like backing your dollar credit. I don't know that I can like harp on this too much. Like so much of the credit in your bond portfolios, your bond funds, so much of this is what you would call unsecured. Like it just sits on the capital structure. You have some bankruptcy positions, but most of these bonds don't have anything
underlying
tied to. Yeah, exactly. Sometimes you might see like a first mortgage, or you see some piece of real estate, or like a utility has assets that they're backing it up. But if you're just lending to like a corporate bond or the U.S. Treasury, it's all just on a good faith IOU, and you just call it unsecured lending. So in an environment where this, the credit bubble just keeps growing, like you think at some point, you keep going through these violent spasms. Like 2008 was a heart attack. Saw minor ones, in other places across the globe, 2012, 2016. 2020 was another heart attack. And once you get into those, it's or you're in a resolution event where you're going into a bankruptcy, and you need some sort of recovery on your credit, right? You should generally be senior in the capital structure or in the proceedings. You want that, I think, as we go into this forward-looking environment and you're investing in dollar IOUs.
Yeah, because if you don't have it, you're going to have massive loan loss.
Yeah, and you're seeing that in the data. You said I was massively prepared. There was a Bloomberg article. I'll find the tweet for you and send it over. But bank loans, there's this kind of niche. You see all these niches in fixed income credit investing, and this little sleeve called leveraged loans. Basically, it's just that. It's like there's a pool of loans, and there's leverage applied to buy more loans, and then you own the equity and layer on that. The profile here, the recovery rates for this newest tranche of levered loans in default is, you see the trend line, it's down, but the Bloomberg print just coming out last week, it's looking like it's going to be like right now, realized rates are like 20 cents on the dollar.
Holy shit.
Let's keep it white pill here. But here's the beauty thing. Like if you're looking, and this is where, you go, we were just in Miami. We went to some talks, 1031 had, a panel up on stage. Like, why would you not, search out this type of backstop in your dollar IOU? We're slow. It takes a lot of time for people who are kind of trained on the existing frameworks. You use the word groupthink, but just like steady habits. You're not just going to throw those all out the door. It was a massive sell-off, but you're not going to totally give up on 40 years of what you learned in your career all in one go. And the other aspect too is this is a tiny, like we were talking about Bitcoin-backed loans. This is a tiny sleeve on the entire dollar credit market. So just for perspective, like how many dollar IOUs are out there, it's hard to calculate. There's no centralized ledger. It's just like surprisingly, if you think about it, it's actually a highly decentralized system with banks all across the globe, securities all across the globe. But there's a industry trade group, the IIF, I think they just quoted it. It's about $300 trillion. That's your credit pile. So this industry, the legacy industry, who's doing fixed income investing, they need size, right? If you're going to invest 300 trillion, like you've got to be big And you start with like, what's the market cap of Bitcoin? Like if you're going to build on that for a new credit layer, market cap is, I don't know what it is, I think just to say $500 billion. And then your daily tradable liquidity, I don't know that number. Like right now off the top of my head, let's trade it on exchange or Bitcoin to dollar markets. It's probably about the size of like an on the run T-bill, like just measuring, but that's just like one QSIP. So it's still relatively small in the scheme or in the like relative scope of this giant dollar credit market. And then the actual, what I would call the good lending, sound lending built upon Bitcoin.
And it's smaller than that.
It's what my perspective on that is, that universe is what Unchained Capital is doing and what they've built out. Like in all of my deep dive due diligence, the conclusion I made was Unchained is, I'm not going to say there's not other parties out there who are sound, but they are
the most sound.
Yeah, the bulk of it.
So to take
it's not that big. It's 8 figures. So
yeah.
What we're doing, like we're just getting started.
Yeah, and to take a step back and to break this down for the freaks listening. So Matt is running a credit fund looking to allocate dollars to credit facilities to get a return on that. And Unchained is very attractive for many reasons. Number one, start with the custody. It's a 2 or 3 multi-sig. It's multi-party custody. So you have Unchained holding the key, Kingdom Trust holding the key, and then the borrower holding the key as well. So the borrower has some insight into that escrow account where the collateral is held to know that it's not being rehypothecated. So right off the bat, Unchained with this product is reducing risks because they've built it in a way where they can't move your Bitcoin to take risk to try to get yield for themselves and their customers. And they don't have the ability to unilaterally move Bitcoin out of the escrow account. 2, the collateral is over collateralized, 40% loan to value. Like you said, put $250,000 worth of Bitcoin in, you get $100,000 in a loan. So if the price of Bitcoin falls, you still have collateral. And another important thing with Unchained, I feel comfortable saying this because they say it publicly all the time, they've never had a loan loss on their book. So any credit lender who's given them money to then lend out to Bitcoiners has never lost $1 that they've given Unchained. And that's when you juxtapose that with the crazy leverage credit facilities that exist out there that are going to return 20 cents on the dollar. That's extremely attractive. And then number 2, you have Bitcoiners who don't want to sell Bitcoin. They'd rather take a loan out and pay a high interest rate because they don't want to eat the tax burden of selling their Bitcoin, and they believe they can do something productive with that money to pay back that loan, keep their Bitcoin, maybe get some more Bitcoin on the back end from producing a productive business that creates cash flows that allows them to stack more. And the APY associated with it is the interest rate on the loan is high because it's deemed risky by a lot of allocators. And so that produces a quality return for these credit funds. And this is something we've talked about at 1031, like the Unchained lending desk, if you're a credit fund, is the biggest no-brainer in the world. People say treasuries are risk-free, nothing's risk-free. Obviously there's risk. Bitcoin can go to 0, which would be a systemic risk to this type of product, though you have to put probabilities on that. I put the probability very low. It's as close to risk-free as you can get when you factor in like the transparency of the escrow, the over-collateralization, and your customer or Bitcoiners that can either pay back the loan, or if they don't, you just liquidate the Bitcoin and the money goes back to the lender. We've been beating the table at 1031. Like if you're looking for outsized credit returns as a credit fund, like you should be pouring your dollars into the Unchained lending desk.
It's yeah, I don't like to use the language of risk free anymore, period.
Yeah.
Because like this is it's an unknown probability distribution of what's in the bag. But at the end of the day, it's track record. I talked about that earlier. Is it launching this fund, being an SEC registered investment advisor, all of that, and the existing track record we've built up since launching our firm. You go into these discussions with you sit around a conference room, or you make a board pitch, you're pitching to, like, it can be any institutional pool of capital. At the end of the day, what they care most about is returns. It's proof of work, right? So ultimately, it's performance is what the equalizer is. Or at the end of the day, capital is going to fund to its highest and best use, or highest and best or its best allocators. And so you heard a lot of discussion about this topic. 1031's talked about it. You've talked about it a lot. I think what's been missing from kind of that plug-in, what we're doing, dollar-backed loans, all of that, Bitcoin-backed dollar lending. One, it's hard to segment out, like, oh, what's the difference between you and I guess we can just name dead names, like BlockFi, Celsius, et cetera. Like, it's hard as a kind of an investment committee member, like you're on a pension or a family office, and you really have to dive deep and understand why is what Unchained's doing different than what BlockFi is doing. Why is their custody model superior to, I call it the absence of a custody model at a lot of these shops who are just there's no on-chain footprint. It's just I have an IOU, a Bitcoin IOU somewhere in a Postgres database or something. Yeah. Like it's really hard. And then on top of that, you got to understand like what's going on in this legacy system. You have to have a view, and then you have to understand what Bitcoin is and what it's doing with its parallel framework. And it's insanely hard, I think, to grasp everything at once, especially coming from a standpoint. Most people making these decisions are going to be having sat in that seat for 3 or 4 decades. So it's at that time where usually you're not going to arrive at these conclusions or make these choices based on first principles. Like, you need to see things work out. And I think, at the end of the day, I met a lot of great people, in the Bitcoin space who are thinking about these things from first principles, building on top of them. I've chosen to build on top of that as well, making that bet. And like ultimately it comes into, I want to pull more dollar capital into the space, allocate to the Bitcoin entrepreneur who's going to deliver goods and services into the economy, solve this problem. Collectively, that's the exit path out, and we win. And to do that, I think the point in this highly regulated industry, like the missing piece is you've got to have track record. At the end of the day, it's a gated industry. So like people won't listen to you. Like most people won't act same way when you tell them, hey, you need to buy, like you should look into Bitcoin. You should read more. You should think about this, whatever. Like 1 out of 100 might answer your call. I think it's the same way. Like the results are what bears out the change and those key decisions at the end of the day.
Yeah. So putting this in the context of how allocating dollars in a credit fund toward a product like Unchained's lending desk, like what could that do to save your average American retiree or somebody saving for retirement? Like how does this help with the transition?
Yeah. So we talked about before, like let's say you're 65 and people make an investment decision usually based on news or something they hear. Most people aren't, process oriented or, putting a lot of structural thinking into why is this a good time to enter a trade? Is this a good time to acquire this asset? They usually just kind of like react. Like there's an emotional kind of driver to that is my opinion. So even if you think this is the promising system, a truly disruptive innovation, it's the framework to build upon. If you buy in 2021, like you maybe waiting, you know what I mean? It's like the same thing of buying at tops of other cycles. And it hurts. And then you're left with this bad experience. And then instead of questioning yourself or taking personal responsibility, you might instead just turn sour on the entire asset class. And I think that's kind of the natural human instinct, right? It's hard to look in the mirror and realize, like, I might have been right, but I was wrong on timing, or I didn't think about certain feature or aspects, or I didn't, hey, I'm 65. I didn't realize I shouldn't have, rolled into something that has at that time frame that has a track record. Every time the dollar cycle enters a contraction, it can draw down 80%, 90%. So where you build in with that pitfall, how do you cross the line there? Well, I don't know. I think just from a creative perspective and looking for solutions, I try to piece together what has promise, what works. And if you think about, well, the bond market was responding to the same, dollar cycle, 2022, that Bitcoin drawdown was. But how do you put the pieces together in a way that kind of fits the parameters for that customer you're trying to solve a problem for? I think that's where the Bitcoin back lending, this nascent space, this growing space, if you do it the right way, with the right operational integrity, with the right people, just do the job well. And I think sought out on a mission to find that, and that's, I think, the rocks we've turned over in the space, what we talked about before. If you put people in that type of a vehicle, that target cut, like work backwards from your customer's needs. You're a 70-year-old, you need income, yet it's an inflationary environment, and you can't take drawdown. Well, maybe 2021 is not the right time in the cycle for you to be accumulating a Bitcoin position, or like heavily in, gradually ramp that up. But the loan profile, if you're dollar credit, same thing, that's struggling from duration or rising yields. Well, if you flip those parameters on their heads, where now you've got a high nominal yield, reduce the duration, and then put a strong backstop behind it, you've now got something to allocate towards for that specific customer, that client, that fits their use case. So I think, from that standpoint, you think about, or the way I think about the envisioning, what 1031 is so good at investing with these companies, building the monetary system, like from the studs out, your strikes, your mutiny wallets, like all of those. Apologies to all the other awesome companies and entrepreneurs I've met doing that work. It's like, okay, now what can I do? And bringing into that for this, I call it the mission of what I've been working on for the last 5 to 10 years. How do we save the fixed income investor? All right, let's build the bridge from that side as well into the Bitcoin economy. And I'd say the promise to get excited about is you can solve both problems and at the same time pull in more dollar capital into the Bitcoin economy, those same entrepreneurs. And that's just a flywheel. Like it's just another asset. It's pulling in more capital into this. I mean, truly a sliver of a space. Like it really is astonishing how much headline attention Bitcoin has gotten with no marketing team, shoestring budgets, a tiny sliver of the population even rowing in the boat in the right direction. It's even worse than that. Like the dollar capital, like from the VC space, and you know this better than I do. I mean, it's like 99-1 going into
it's absurd
crypto junk and just exit schemes. So I don't know. You start small, but I think this is one more bridge. Sounds fiat, right? How do your business is focused on a mission of bringing more dollar IOUs into Bitcoin. It's like, no, I like if this is hopefully transitionary in terms of where Bitcoin is going in the grand scheme of things, but in the day-to-day picture, pulling in more dollar capital into the Bitcoin economy pulls in more resources for Bitcoin development. And I think, as I map out the economics, what it does for the entrepreneur, I said this before, I don't like the idea of retail borrowers collateralizing their Bitcoin. Like you need some sort of value creation where you're going to use that dollar capital create something into the economy. You cover that high cost of capital. Like 14% is hard. Like this is a credit card rate type of hurdle. But in terms of access, if you're a business, you need, if you're an energy miner, you need ASICs. If you're, or a new pipe to get your well connected into the, the existing legacy network, you're a farmer, I haven't met the Bitcoin based farmer yet, but I'd love to hear that episode on TFTC. But, the shout out from the live RHR in Miami, that dry cleaner, right? I love hearing that. He's like, how am I going to incorporate Bitcoin into my business? And this is where, as an entrepreneur, as a business owner, like it's on you. Like you have to be the master of your income statement, your P&L. But if the problem is capital shortage, and I say dollar capital shortage, ironically, the problem we're looking at right now looks to be a shortage of dollar capital, not a surplus, right? We think about the money printing, like there should be dollars flowing everywhere. It's actually not the case. You have bank balance sheets constrained in the domestic banking system. You see the data in the high yield bond market. So the more you venture out on riskiness as a business, like credit risk, the less willing the existing system is to fund your project, your business at this point. So stepping in there, and it's also like the smaller your business is, the more risky you are from the system's perception. And I think, in terms of actually resolving the problems at the base layer, you just flip it on its head. It's more likely the exact opposite. Bet on the entrepreneur, bet on the soundness that those that do survive are the ones that are going to be the ones that exhibit strong balance sheet management, strong capital discipline, manage their income statements tightly. Those are the ones I want to see allocated capital to. And in this case, Bitcoin is the vehicle that gets us there.
Yeah. Speaking of flywheels too, I love that this is like a bridge product where it's like, all right, you're 70 years old. You don't want to ape into Bitcoin, but you do. You don't even have to understand like the loan dynamics and the collateral and what happens, but you just want to see the performance. You can get a return of 10 to 12% after everything's chopped up in a credit fund, which is extremely high for credit funds. And they get into it and like, oh, this is backed by Bitcoin. Then maybe Build does this successfully. Unchained keeps running their desk successfully, and your returns outperform a lot of your competition, and then that sends a signal to the market. They're like, hey, what are these guys doing? And it forces people to dig into your strategy and what you found, and that leads them to Bitcoin or the collateralized loans, and then to Bitcoin more broadly. And it's just, I could see it being a legitimization of Bitcoin as super collateral that people really don't recognize yet, which forces them to ask questions, to learn more, to get closer to the point where they realize like, oh, this is not just some pyramid scheme. It's actually something that's very foundational to our transition into the new monetary system, to a new monetary order, if you will.
Yep. And I think human beings are, we are clever. We go towards what works. And in this environment, like the business owner, was hitting on this before, if there's a capital shortage, you can't get a loan from your bank. The only capital is going to be available to the highest quality borrowers, perceived by the system, U.S. Treasury, your large cap companies, Apple, Google, Meta, Oracle, all of those, and the biggest issuers in the system. What do you do if you're the small business owner? That's kind of where the rubber meets the road for most of the goods and services we consume that keeps society running. And humans are problem solvers, and I think they're ultimately going to move towards what works. Like, just how do I survive? How do I create value? So that's the beauty of it. I was going to say one more thing, like the TFTC rebrand of Truth for the Commoner. I think that's awesome. It puts to the conversation we've been having. You just start from that perspective of what is this system offering the commoner, right? retirement accounts and your primary residence as your bedrock. And you think about what's the cracks showing up in the system, the problems, inherent in everyday life, the problems for a small business owner. It's like, what more is there, right, than to just show people for Bitcoin, like, no, this is something that works for that broad group of people to help our entrepreneurs, our communities move forward.
Oh, thank you. It's funny, because most people would find this conversation or like this subject, retirement accounts, like boring, but like after sitting down with you for 2 hours now and digging into it, not only not boring, it's like a big problem that people should understand, and the perception of it being boring has probably allowed the problem to get to the extent that it has.
And it resonates with, if you put it in a word cloud, like the driving ideals of Bitcoin, the low time preference, right? What is retirement saving? Like, you're supposed to, like, I work today to put a nest egg aside for tomorrow. Like, that fundamentally is just a core concept of the understanding of what Bitcoin offers. So I think it's like these big picture moves and how people move towards systems and all that complexity. You gradually shift towards what works, and it's a messy process. But yeah, hopefully this is additive and across all parties too. Like a win-win-win is kind of what I'm hoping to accomplish.
Yeah. Well, thank you for doing what you do. I think it's very important. I think I made that clear through our conversations off air leading up to this. It's, again, I mentioned this is something we talk about a lot at 1031. It's like no brainer. The Unchained landing desk, if you're a credit fund allocator, just for some reason.
I don't like the word no brainer because it implies you didn't put any thought into it. So you need to get people to think. People are like, there's a shortage of thinking sometimes, I think, in these decisions, and an over reliance on what a committee tells or what a consultant tells you or what you learned for 30, 40 years. It's like, who moved my cheese, that boy. Like, you got to be the mouse who thinks about where things are heading, not what worked in the rear view mirror.
Yeah. Well, this has been an incredible conversation. Very dense. We dove into a lot here, freaks. If you're listening and you want to read the charts, I'll have Matt send me a PDF. I'll put a link to the PDF in the show notes, so you guys can follow along if you're listening, or if you want to go check out the charts after listening. And obviously, if you go to YouTube, Spotify, Rumble, you can see the charts, Bitcoin TV, for yourself. Matt, again, thank you for doing what you do. I think what you're building at Build is extremely important and can be, excuse me, like a model for allocators in the traditional financial space to unlock something that shows them the way to creating this bridge to a Bitcoin standard and helping using Bitcoin as a way to help what they do in a day-to-day basis with their allocation strategy.
Yep, it is hopefully the lifeboat.
For any freaks that are listening and want to find out more, where should we send them?
Yep. So on Twitter, my handle is BuildCIO, just letters CIO. And then from a product space, what we talked about today, this project that we've undertaken with Unchained, for right now, we talked about how do we bridge the gap, solve problems for the middle classes. Right now, the only way we could do this is in a private fund offering, and the requirements there require that we only work with accredited investors. So there's certain standards that need to be met. So big picture goal, what I want to work towards is expanding this to all supplies of dollar capital, because this is the dollar credit problem impacts everybody. What's going on in the legacy system, and just investors across the board. But right now, just how we could map this solution onto what was feasible and attainable for the first, I'd say, run at this. The requirement in it is we have to work with accredited investors for the Bitcoin backed nature of dollar IOUs that we discussed before. But we've got a site up at buildbitcoin.com. It's a domain I was really happy I was able to still get back in. I want to say I got it in like 2020, 2021, but we're using that as our kind of our masthead on describing this project. So I think that's what the Bitcoin audience here today will be most interested in. But that's kind of the landing point if you're interested in learning more about what we talked about and what I'm going to be working on to solve this big picture problem from the Bitcoin focus perspective.
Thank you for the white pill, Matt. We need more white pills.
Awesome. I think we can do this. I think we can do it.
I do too. We're going to win. We're going to win. Freaks. Matt, it's been a pleasure. I'm sure we'll talk soon. Thank you for coming on. Enjoy the rest of your afternoon. And yeah, that's all we got today, freaks. Peace and love.